Hello and welcome to Chapter 9 Notes. I'm on page 167 of your course pack, okay? So Chapter 9 Notes covers accounting for receivables. So a lot of this we have talked about in prior lecture videos. We should know by now the journal entry to record a sale on credit, for example. Some of those things we'll talk about here in this first lecture video. We'll kind of give an overview of accounting for receivables. What do we mean by receivables? But that should be kind of review, okay? And then later on in the chapter, we'll talk about some new things about, for example, the allowance for doubtful accounts. What do we do if somebody doesn't pay us? Because so far we've been assuming that all of our customers are going to pay us, and that's not always the case. So we'll talk about what to do with those situations, and then we'll also talk about notes receivable, and then we'll also talk about selling accounts receivables in order to get cash now. All right? So those are a lot of things that we'll talk about in this chapter. All right? So let's go ahead and start. So we know what a receivable is. It's just an amount due from another party. So we make a sale on credit, for example. And again, the whole idea of making a sale on credit would be I sell someone a product. I'm a company, I'm the UMW bookstore, and I sell something to someone, and then they say, I can't pay you now, I want to pay you in a month. I can record the sale, right? I would debit accounts receivable, and accounts receivable, remember, is a current asset on the classified balance sheet. Accounts receivable is a current asset on the classified balance sheet. So I would debit accounts receivable and then credit sales, and I can recognize that sale even though I haven't gotten the cash, just when I pass title because of the revenue recognition principle. All right? So other examples of receivables are also interest receivable. We can also say notes receivable. That's another example right over here that you could add to your notes. Is notes receivable. And the difference between an accounts receivable and a notes receivable is that a notes receivable has interest. And it would also be for taking out a loan from a bank, for example. You would take out a notes receivable, or if you gave money to another person, if you lent money to another person, you would have a notes receivable. Okay? So we've talked about this before. Accounts receivable are amounts due from customers for credit sales. We make a sale on credit, or the other term is making a sale on account. Okay? And so the journal entry to make a sale on credit or a sale on account is we're going to be debiting accounts receivable and then crediting sales. Now, this is something a little bit new that we're talking about right over here. We know what we did back in some of the previous chapters, chapter 2, for example, where we made a journal entry and then we posted to the general ledger. So remember, we debited accounts receivable, and then what we do is we go over to the general ledger, and then we increase the accounts receivable account, debit accounts receivable, in the general ledger. We put it on the debit side of the general ledger. So we do our journal entry in our general journal to record the sale, and then we come over to the general ledger and we increase accounts receivable in the general ledger. Here's the thing, though. The general ledger keeps the total accounts receivable. It doesn't say, Joe Hart or Sally, whatever customer that we have, they owe us this much money. It doesn't say that in the general ledger, right? It just says this is the amount due from all of your customers. But we need to keep track of which specific customers owe us money. Otherwise, we can't go knocking on their door and say, you owe us money. We have to know that. So we keep track of that in a supplementary record called the Accounts Receivable Subsidiary Ledger. And in the subsidiary ledger, we maintain a separate accounts receivable for each customer. So what we would have is Joe, Sally, Anna, Jennifer, so on and so forth, Paul, Kristen, Lexi, Robbie. I'm going through my brother and my family members' names there. We would keep track of all of their individual receivables that they owe us, and then what we could do is add up all of those, and then that should equal the total in the overall general ledger. Okay? So that's what I'm saying here is our general ledger has a single accounts receivable at the summary level. So it says, here's the amount due from all of your customers. But if we want to know the detail for each customer, we have to go to the subsidiary ledger. All right. And so then what we also have is a schedule of our accounts receivable that would show the sum of our individual amounts in the subsidiary ledger equals the balance in our accounts receivable in the general ledger. All this is saying is that if you went through and you added up the amounts due from each customer from the subsidiary ledger, that should equal the total in the general ledger. If it doesn't, there's something wrong. Okay? All right, so let's go on to page 168 here. We look at this example. It says, let's look at two transactions on July 1st between TechCom and its credit customers. The first is a credit sale of $950 to ComStore. And the way that we do that is a credit sale. We debit accounts receivable and then we credit sales. The second one is when one of our customers, RDA Electronics, pays us. Okay, so let's look at this journal entry. These are both on 7/1. We come over here on 7/1. To record a credit sale, remember we debit accounts receivable, and I'll abbreviate accounts receivable AR for $950, and then we credit sales for $950. How does this keep the accounting equation in balance? Remember, assets equals liabilities plus equity. Accounts receivable, where do we put that in terms of the accounting equation? If you said assets, you're right. It is a current asset. So assets go up. Current asset. Sales, how does this affect the accounting equation? Well, sales is revenue. So as revenue increases, equity also increases. So that's how this journal entry keeps the accounting equation in balance. All right. Then we got paid by our customer RDA Electronics. What is the journal entry? Whenever we see we got paid, what do we always debit? If you said cash, you're right. We debit cash. And then we don't have as much accounts receivable, right? So we have to credit accounts receivable. So we debit cash for our 720, and then we credit AR accounts receivable 720. Okay, how does this one keep the accounting equation in balance? One asset cash goes up, another asset accounts receivable goes down. Why am I crediting accounts receivable? Because I don't have as much. They paid me. So my accounts receivable balance from them goes down. I'm not waiting to receive as much cash anymore because they paid me. All right. Now I say right here, of course, when we make the sale, we would also debit cost of goods sold and credit merchandise inventory. I'm leaving that out just to focus on the sales, but remember that we would also do that. And we can't do that anyways here because we don't know the cost basis. We just know how much we sold it for, which is right here, but that's not the cost basis. We would debit cost of goods sold and credit merchandise inventory for the cost basis, just like we did back in Chapter 5 lecture videos. The other thing is, I'm going to look on this next page. Well, let me comment on this bullet before I look at that next page. It says, note that a credit sale is also posted. So this goes to the general ledger. So this is our journal entry in the general journal. And then what we would do is come over to the general ledger and increase accounts receivable in the general ledger by $950. But then the other thing that we also have to do is go to the subsidiary ledger for ComStore, which is our customer, and increase their individual accounts receivable. So we'd also have to debit their accounts receivable. So if we look over here at this diagram, we can see what's going on. So we're going to increase on July 1st this accounts receivable right here in the general ledger. And then we can look at ComStore. Look, July 1st, $950, ComStore right over here. Okay, so then what we can do is show our schedule of accounts receivable, where if I add my RDA balance for accounts receivable, which is $280, plus my ComStore accounts receivable balance of $29.50, that gives me $3,230 total accounts receivable. And then I can look to the general ledger and see that my total in my general ledger for accounts receivable is $3,230, and then that reconciles. So the detail, if you add up all the detail, you should get to the total. And if you don't, something went wrong. Okay? Something went wrong. All right. So let's continue on and talk about credit card sales. So a lot of companies let their customers pay for products with credit cards, as we know that. We know that because you've used a credit card, I'm sure. Okay. Why do companies let you do that? Because they're charged a fee, right? They're charged a fee for doing so. Well, there's a couple reasons. First, the company, right, that made you the sale, they don't have to evaluate your credit standing. So if you go to a restaurant, you pay with a credit card, if you didn't use a credit card and you didn't have cash, that restaurant would have to give you credit. So they would have to extend you credit. That means they have to check your credit history. That means they have to make sure you are credit worthy. That takes a lot of time. So what they say is, you know what, I'm going to outsource that to the credit card company. Because when that restaurant makes a sale, they get paid by the credit card company, and then you pay the credit card. So basically what the restaurant or any vendor has done, any company has done, is they've outsourced the credit worthiness checks to the credit card company, and they've also outsourced the collection of the cash to the credit card company. So they don't have to deal with it. And that makes a lot of sense, right? Because a restaurant doesn't want to be in that business of having to check everybody's credit and also coming and asking, hey, did you pay your bill? Did you pay your bill? Did you pay your bill? They need cash right away. Okay? They need cash right away. All right? So that's what I'm saying right over here. Why companies use credit cards. So again, the seller doesn't have to evaluate each customer's credit standing, avoids the risk of extending credit to customers who can't pay, because again, the restaurant gets paid by the credit card, and then you pay the credit card. And if you don't pay the credit card, then the credit card company is going to be the one who comes talking to you, okay? The seller, the restaurant in that case, would receive cash right away. They're going to receive cash pretty soon, or a lot sooner than if they had outsourced the credit directly to the customers. Okay? And by doing this, by extending credit, they can also increase their sales. All right? Now, not all companies accept credit cards. If you've ever been to Carl's ice cream here in Fredericksburg, you would know that Carl's is cash only. Right? Why don't they accept credit cards? Well, they don't have to. That's why. They don't have to. And it's because everybody wants to go to Carl's. Have you ever seen the line there? It's out the door all the time. Even on a rainy day, there's people waiting to line up to get Carl's ice cream. Why don't they want to do credit cards? Well, they might be able to increase their sales volume, but it's probably going to take a little bit more time. They've got their cash down hands. It goes by really fast. They can process that order really quickly, and they just do cash right there. The other problem is if they start accepting credit cards, right, is that the credit card company will charge Carl's a service fee, a credit card fee. So the credit card company charges the restaurant or any other company a fee for using that credit card, for allowing customers to use that credit card. So the credit card company charges the restaurant, or Carl's in this case. And Carl's says, we don't want to pay that fee. And you know what? We don't have to. Because we're Carl's and everybody loves our ice cream. So why would we accept credit cards, which is just going to dip into our profit margins? So they don't. And they don't have to. But a lot of companies, other restaurants in very highly competitive industries don't have that luxury. So they have to accept credit cards because all their competitors also accept credit cards. So if they don't, they're at a competitive disadvantage. So I guess what I'm saying here is that while credit cards can give these options, there's also the idea about credit cards with restaurants that if they don't allow you to use a credit card, they're at a disadvantage. So in some ways, the use of credit cards may not provide that many advantages. It does provide some advantages, but it's more that if they don't do it, they're at a disadvantage. Okay, so I'm going to end this lecture video now. In the next one, we'll talk about journal entries for credit